Hello, everyone. Welcome to today's session. Let's jump right into it here. Market conditions continuing to be bullish in this bull market. Let's start with this chart here because we want to spend some time on this current bull market rank sitting at 24.44. We're at the end of the range here. We've had working on a 5-wave count, and this is that 25 number that's up in this range here. So we definitely had a really nice run here. Lots of questions on whether or not we're going to retrace, whether we're going to have a blow off top, whether we're going to have a deeper correction. Lots happening at these levels. So really what we can talk about is probabilities at this point to say, what are the probabilities that we keep moving higher from here without some kind of a retracement. It's getting the probabilities are getting lower and lower and lower the higher we get. So let's we'll focus a little bit about on that, and then also some ways to be able to manage that and adjust for that short-term market timing. We're at the upper end of the range. We've had some momentum spike back up again, and we've seen a breadth actually participate a little bit more yesterday as well. So momentum's had been up in this extreme range that has pulled back now into a more sustainable move, and this chart isn't really clear to be able to see that, but those extreme levels happening here and a little bit of a pullback. That's all it takes sometimes to go from extreme back into a more sustainable trend location is, pardon me, a 2 or 3 day retracement. We've seen that so far. Whether we're going to get some acceleration on the selling, that's really the big question right here. Now, the last rally that we had when we were talking about momentum, and we had this spike right up here, so that was early on in this last trend, and then it was really ugly, choppy, lots of ups and downs right through here, and then we finally got a little deeper retracement that took us back into that oversold area. And so there is that possibility as well that we continue to, maintain the upper end of this range, but we have some volatility here as well. We did see a little bit of a move back up into the breadth indicator. I'm going to go over a couple other charts here as well that I found interesting this morning, and then also sentiment. Sentiment is in relation to VIX, so we're not seeing any fear. What we are seeing is a huge amount of complacency still, which is also fine. Nobody's wanting to sell, nobody's wanting to aggressively buy, and no real big cracks that have been sending anybody headed for the doors, at least quite yet. That can happen so fast, especially in these upper ranges. We saw a little bit of a retracement on some of the big high flyers like NVIDIA. We'll spend some time on looking at some of those leaders as well. Buy-sell ratio, we had already been in this bearish state really all month. Most of June has been really bearish breadth. We've had a buy-sell ratio that has been less than 1, sitting right down here. Let me get rid of this guy right down here we're at 0.46. We're still less than 1. We've been down to 0.32, 31. Oftentimes when we see a real significant market bottom, that buy-sell ratio drops all the way down to something like this, down to 0.09, down to 0.08, and so those are major bottoms. We just haven't seen this is obviously not a major bottom. It's just a lot of stocks not participating in the uptrend. Let's look at a little bit different perspective on this now. This has changed significantly though just in the last day, because what happens on this buy-sell ratio is it's either in the sell range or it's in the buy range. So it's either in the upper momentum zone or the lower momentum zone, trending down, trending up. What it's not accounting for are all of these that are stuck in the middle. So when we have a bunch of stocks that go from hold to buy, which is what happened yesterday, we actually had, this number was at 7 on the Dow. This number I think was at 4 or 5. So now you're getting stocks shifting from sell back to hold, and you're getting from stocks shifting from hold back into buy. And that's happening. That happened on Dow. So now look at the buy-sell ratios. Right now they're pretty skewed to the upside, 12-1, because you've got 12 stocks to the upside, you've got 1 to the downside, but you've got a handful of stocks in hold. So this actually potentially could get even better if these stocks start to look strong and move back to the upside. If they start to get weak, that could be the dance that we're starting to play right now at the upper end of this range is rotation, money shifting out of real aggressive names and moving back into Dow type names or larger S&P names. as well. We'll see how that ends up ends up panning out. It's one thing I've been talking about the last few days in the morning update is which is going to catch up. Are we going to see all of these leading stocks roll over and move lower with the rest of the market, or are we going to see the rest of the market say, hey, maybe things aren't so bad, let's jump back in and things start to head higher as well. Those are that's kind of yet to be determined. But in terms of, and that's looking too far forward. We don't want to look too far forward. We mostly want to focus on what's happening right now, and then look to see as that changes each day. So today it's changed in terms of S&P 500 and the buy-sell ratio. It's coming back a little bit closer together. Sentiment had been extreme and now pulling back a little bit. And if we equate that to the S&P 500 chart, you can see it's really just relatively flat right here. Not a whole lot happening, but we are seeing a slight move back up in breadth. Let's take a look also at, if you look at sectors, and one other additional confirmation, one way or the other, either bearish or bullish, is do we have more sectors participating? We've got one more up in the buy zone, and we had 3 or 4 that jumped from that downtrend back into the hold, and then we had a whole bunch of them, almost all of them, start to move back into this short-term trend up. So really, when you get a short-term trend up, let's see if we can find an example of this. Maybe utilities. Not so much. That's kind of moving a little bit back down today. So that's that short term back up. If it closes right here, then that'll shift back to a sell today. But so, you know, markets are trying, but some of these are at the bottom end of the range. That's utilities. What I was looking for, let's see what that transportation looks like. Yeah, it's kind of the same thing here. Just still some weakness overall. Things are fighting, trying to head back up. There's real estate, an attempted move back up, and now some reversal. That's one of the things that I also wanted to talk about. If we start to move over into more of a bearish tone, is when you're looking at this 6-month time frame, remember that the bearish setups work the same to the downside as they do on the upside, and that is, here's our time frame, here's our 6-month time frame that I typically like to use. Now is the Fibonacci tool, which is this button right here. If you click on that, it's going to add this Fibonacci tool, which connects to the high and the low. When it connects to the high and the low this direction, saying the highest point is over here and the lowest point is over here, obviously that direction is pointing down. So that helps us also notice that the 6-month time frame, the trend is down, and we can kind of see that the trend is kind of flat, but also has kind of this downtrending move. It's finding resistance right here. So as it works back this direction and is finding more resistance and it reacts bearishly at these locations, you get selling, you get a topping tail bar, you get more selling today. And that may be the overall trend, that you're getting selling back into the resistance now. That could also be an indication that the markets are starting to shift. Each of these sectors are really separate little pieces of the economy, so they're not going to all be the same. We obviously know that technology has had a big run up, but it is one of the ones that's had a little bit of a break right here in this downtrend. Nothing too significant, nothing too severe, a normal looking counter trend retracement. But some of these other areas of the economy are not doing quite as well. Let's take a look at some of these weaker consumer discretionary. This still has that uptrend, but you're seeing a little bit lower highs, some resistance here as well. It's just that, it's that breadth, it's that additional participation that we're just not seeing. That needs to be a red flag still at this level, in addition to the fact that we are in the stratosphere as far as the level of the bull market. Okay, what that shouldn't do is give us confidence to say, wow, this thing is going to go forever. Because the second we start to think that, that's when it reverses and we get spanked a little bit. So those are, we've got to trust the fact that markets don't go up forever. We also have to realize that markets always revert to the mean. Okay, either direction. If the mean is an average, and I draw this chart where we have kind of that sustainable price trend about that 45-degree angle, not always, but in this case, you know, something like this, we know that we've extended up. We're going to eventually pull back, whether it takes, you know, correcting here and then an uptrend and then down and then an uptrend and then down. That could take years. Okay, or we could move up and continue to move sideways and head higher. or we could just completely fall off the table and completely come unglued. Okay, that's not happening as of yet, but those are all possibilities at this level. But these are things that we want to start planning for and preparing for a little bit now versus when it starts to happen and when we get that selling and it's pretty aggressive and pretty painful, because those are those happen quickly. So in terms of management at these levels, now we've talked about this a lot in the last 3 months, because it's felt like this upper trend in the last 3 months. We know it's moving the market. We know it's tech stocks. We know it's money going into AI technology, chips, computational power, data centers, and all of the big heavy hitters are spending money, lots of CapEx spending, and all of that spending is going to NVIDIA. And so NVIDIA has been really the big talking point. And let's look at that chart right here, because we did have a retracement back down, sitting at the support level, up nice 5% today. But this will be an interesting price pattern to see if NVIDIA can start to hold up right here, find some more support, and continue higher. This 2-year time frame on NVIDIA, you can kind of see now where we're at, and we've had just this massive run up. Now a little bit of a retracement. We're still relatively healthy, but it could turn into this, and it could be it could start to roll over. So we definitely want to trust the price activity, not necessarily all the talk and all the hype. It's genuine, there's no question, but markets overshoot. What's interesting also is a lot of big institutional investors will use PE adjustment for their valuation metrics. So for example, if you look at this PE number right here, PE just means price to earnings ratio. So the P in PE is price, and the E in earnings is, or the E in the PE ratio is earnings. So a PE ratio is the price of the stock divided by the earnings of the company, or vice versa. I forget which is divided by which, but in this case, it gives you a number. So you're saying, what is the price in relation to the earnings? And sometimes you'll just get funds that'll say, we're not going to buy anything unless it's in a PE ratio of this or that. And there's lots of objectiveness to that as well, because it depends on sectors, it depends on different things as well. But what's interesting is when you use that valuation metric, watch over here, I'm going to circle this price point. I might have done this before, but if you watch this number, as I'm moving, oops, let me see if I can get that back. Okay, there we go. I want to keep that. I just want to go to here, and I want to mouse over, and I want to go back. So right now the PE ratio is 77. Okay, if I go back, you can see as we're moving down, 74, 78. Okay, so the PE ratio right now is the exact same PE ratio as it was back here, 77. Okay, so the earnings have been continually justifying the price activity, because you'll get a price action that'll move up to that level, and then at some point, you know, if we were to go back even a couple more years, let's go back 2 years and see what the PE ratio is back here. Okay, look, the PE ratio right here is 200. It's 100. NVIDIA hadn't started its massive earnings quite yet. So in this case, you know, when you're talking about valuation and is it justified? Well, for a lot of those large, and it doesn't matter to us, you know, if it's the valuation of this or that, it's the big institutions that are moving this. And so they're going to be saying, is this justified, and can they continue to earn, you know, double digits every quarter? At some point that also is going to slow, but is this massive growth continually justified? Well, it's got a lower PE ratio right here than it did right here. The PE ratio back here was almost double. So you know, that's the argument, that's the justifying, is the price currently worth where it's at? You look all the way back here. PE, here was the last time it was at 77, and then it got up to 105. Okay, so the earnings have been massive in this company, and price, a stock price is simply the present value of the future earnings of the company. And the stock market is a marketplace for all of us to decide if that valuation is justified or not. If I think the stock is going to go higher because of X, Y, Z, I'm going to buy it. If someone else across the street says, I think for those exact same reasons I'm going to sell it, then they'll sell it, and then that's why you get this marketplace, and that's why you get these moves higher and lower. So in terms of just price activity and this PE or this multiple expansion, this is the argument: is the price of NVIDIA, it actually potentially is cheaper than it was all the way back here at $23. Okay, because of the earnings that are coming in. That also is, it's not sustainable. It's going to correct or retrace or pull back to some level. But if the earnings continue to be good and the market is going to compensate or give this stock the benefit of the doubt to the upside and say, hey, maybe we'll justify a 100 PE. Well, this thing could skyrocket even higher. So there is rationale for a lot higher price in NVIDIA and stocks like it, and that is in terms of just the earnings expansion. The earnings are moving so fast; they're actually moving faster than the price right here. So that's an interesting perspective, but it doesn't necessarily mean now's a great time to buy. It doesn't necessarily mean now's a great time to sell. It just means that when you get a lot of people using similar type of metrics to determine valuation, and PE is a pretty common one, whether or not it's good or not, it definitely is one measure of valuation. And in this case, you can kind of just see from that quick example that the valuation, the price to earnings ratio right now is lower than it was when the stock was at $23. Okay, this is all split adjusted now. So a pullback to support. We'll see if we get some dip buying right here. This perspective looks a lot nicer than this perspective, and sometimes this perspective changes our bias. It kind of freaks us out because we remember what I said how high is high. When we see this, our brains say this is way too high. Well, it's only because this is where it's come from. But in relation to where it's at right now, it's justified to be here at these levels. And so a shorter time frame kind of spreads that out. We know that we know on the 6-month time frame we want to be at the upper end of this range. We know that a retracement back to 236 is also okay. What we do also know is that once we start to get into this perspective right here, when we get back to a hold, short-term trend is down, long-term trend is up, and this needle starts to get about right here, that's a decision point. That's a turning point. We're going to either get some support right here and it's going to move higher, or it's going to break down and that's going to start to head back to that sell range. And then we may get something like this where we float along in yellow for a little bit, maybe we hit red, and then it does reverse back. But if it doesn't, then we're already out of the trade. Okay? If it never does correct and it never does find support and it never ultimately gets to where we want it to be, which is back up here again, then no harm, no foul. We're out, right? This is what typically happens in real good, strong bull markets and real good, strong stocks is they retrace, we end up getting stopped out or selling. We have an opportunity now to say, okay, new trend is developing. Let's jump back in that. Versus, it's just completely getting smashed. Let's look at, I want to look at Walt Disney. I think this is an example of this right here. Okay, as you're moving in that upper trend and you're continuing to move and everything seems rosy, and then all of a sudden it's not. All of a sudden we're retracing back down, and then we're in this downtrend. Versus had it reversed back up and given us a new buy signal, then we could say, okay, well, there is some demand, there's some strength coming back in to the trend. That's why we want to avoid this as much as possible. We don't want to try and buy this dip. We don't want to buy this dip. We don't want to buy this dip. We don't want to buy this dip. It's getting closer though. You can see that little bottoming formation. If it holds some support and can kind of break back up this level, then we may get a green bar. There's still a lot of work to do though, right? Because we get these deeper retracements, the trend can still shift and it may ultimately start to work that way up, versus what we want to focus on most of the time in a good solid trend is a stock that's already up here like this along the way up. Once that starts to give up that trend, then we'll move on to something different and we'll wait, and Disney will show up again at some point. Once it's given a new buy signal, that's going to show up in the new buy list right here or any of the scans that we've got. And so that's why, it's say, I bought Disney and it just keeps going lower and lower and lower. Let's look at a little bit longer time frame. Okay, Well, that's what we don't want to do. Here's an example of when it did reverse. Okay, this is what we have to be prepared to be able to adjust to, is say something's happening. I don't know if this is going to fall and turn into this, or if it's going to turn into this, but I don't want to wait around and see. I want to be out of the trade at this point, and then I can revisit the trade if it gives me one of these. In this case, it didn't, so I didn't revisit it. So we want to wait for those trends to start to work their way back up again. Even on a name like, Disney, we assume that Disney is an amazing company, an amazing stock. It is an amazing company, but that, their growth, they're just so huge to try and get the growth that they need to move the pedal on the stock price. It's tougher to do that. And as you get some of these retracements back down, there's just no reason. This also tells us, this rank says it's not one of the stronger ones. It's in the top 70% because of this move, more than likely, but it's showing some weakness as of right now. We want this to be up above 80, ideally, or even above 90. That means that it's currently trending. So when we have a little bit higher rank, we also know that we're getting stocks that are trending. So these lists are designed to be sorted by rank, so that I can say, oh, I know that anything in the 90s, Meta, for example, it's moving higher. It's already moving higher. Rank's telling me it's moving that direction. Signal then and trend is going to help me understand when's going to be my timing to focus on getting back into that trend. Would have gotten out of that trend here, gotten back into this trend here. Now you'll notice it's about the same. One thing as you're adjusting trades is we can't second guess ourselves or look back. We can learn from these experiences by looking back, but we can't look back and say, oh man, I should have done this, or I should have done that, or I could have done this, or I might have done this. It's irrelevant at this point. It's the woulda, coulda, shoulda that ultimately beats us up, creates fear, helps us make bad decisions going forward, because we end up chasing something that we think was going to be something good that we wanted at one point. So it's a process of following the same methodology. Now, notice what I haven't talked about. I haven't talked about one thing about what anyone else thinks about Meta, or what analysts are saying about Meta, because who cares? Okay, the price is everyone's decision, all real time right now. Okay, anybody that's making decisions on Meta are making decisions with their money. They're either buying or selling. That's what I want to focus on. I want to focus on what the price is doing of the stock that I'm interested in, because that's real-time truth. That's real-time data. It's not a speculation. It's not an opinion. It is simply the price is moving higher. Okay, therefore I'm following that trend. The price is moving lower. Therefore I'm not following that trend. Okay, we're focused on price. And the colors and the signals just help us place where the stock is inside of those trends. Is it strong in the uptrend, which is green, or is it yellow, which means it's starting to slow down or shift trends? Okay, notice here it goes from red back to yellow. That yellow means that I don't know if it's going to roll back down, or if it's going to start to move back up. So ideally, we're out of this entire mess. We don't even have to look at Meta until a few weeks ago of, okay, this is interesting at this point. And that could be on any stock that you're following or tracking, or, and a lot of times we want some of those names, Meta, Google, NVIDIA, those are fantastic companies, and they're definitely worth looking at, owning and trading. Now, we only want to own them and trade them as long as they're working. Okay, a stock like Disney, we just looked at, it could have gone higher, but at some point it did this as well. Stop out, take profit, take loss, break even, whatever the scenario is, and then we move on. We wait for it to recover. We move on to something that is currently working in the current environment, versus waiting for something that we think that was working at one point. Now it's not working. We wait for it to work again. That sometimes never happens. Sometimes the leading stocks of one trend are not the leading stocks of the next trend. And that can even be within, the quarterly trends, 2 or 3 month timeframes. But this current uptrend is about AI. Meta is going to be a huge player in that as well. So kind of a little bit different topic discussion today in terms of what we're looking for, but really that's one of the focuses. And stocks spend most of their time in trends. Okay, if I were to go back to that NVIDIA chart, and look at this 2-year time frame, and I may have done this before, but look how much yellow you see. Okay, the yellow is the transition here. It's here, it's here, it's a little bit right here and a little bit back here. And the reds obviously are small and short because it's not in a downtrend. If it was in a downtrend, the red would have been longer. But the current uptrend has been green. So in this case, and in most stock trends, this is what we're trying to capture. We want to stay in the green portion of this trend as long as we can. We get some whipsaw from time to time. Whipsaw is when it makes an attempt at the new trend and then it fails and it reverses. It makes an attempt, it fails and reverses, and then finally it takes off. Okay? As momentum traders, we have to allow for whipsaw and be okay with that, because typically the stops are pretty small. If we buy in and we stop out, we buy in and we stop out, maybe that's a 5 to 10% loss on each of those trades, and then we get a 60 or 80% move in this trend. And then we stop out of that trend, and then we re-enter the trend, and then we stop out of that trend. Okay, we're playing these trend directions as long as we possibly can, and when they stop, we move on to the next one that is that has a possibility of creating a new trend or being involved in that new trend. Carvana is interesting right here because it's had some volatility, lots of ups and downs along the way here, but it's also entering into this. It had a new signal yesterday, up today as well, and working towards those new highs. Will that ultimately continue or not? Who knows? But nice green trend here, nice green trend here. They're pretty deep retracements, but this trend was right here as well. Okay, this yellow gives us an indication that it's just not quite working. Why is that? Who knows? But it's not. Do I need to sell? Do I need to take some of the profits while I've got them? Do I need to exit the trade entirely? So and I like to use this. The 2-year chart helps visually see that a little bit better. The 6-month actually helps us a little bit more with implementation, with the actual execution, because it's like, oh, okay, now this is home. This feels better. I've got an uptrend. We're above the 236. Here's my confirmation bar. Set a stop loss here, and go with that until it continues to move. Once you get that, then you can adjust your trailing stop. It continues to move higher. We use this 236 often for a trailing stop as well. I'll cover that a little bit more on Thursday. I want to go through these trade entries a little bit more as well, because essentially as we're going through these and you find a stock that you want to trade, let's say it's Redwire, RDW, big volume yesterday, massive confirmation bar, a really aggressive trade. It's a 99% or 99 rank because it's had this massive move here. We're up in the momentum zone. And if I were to say, okay, I want to take a trade on this, then what do I need to do? Well, I need to determine my risk. We've talked about this as well. The number of shares. If I'm buying it, let's say that I'm buying it just right at this current value, and I have 100 shares and I have a $100,000 portfolio. I'm at 0.6%. I can go higher than that. So let's go 200, 1%. My range is typically around that 2%. So if I went 330 shares, now I'm at 2%. That means that I have $2,000 at risk. If you have a $10,000 account, that means you do 33 shares. 33 shares would mean you have $200 at risk. And so we only want 2% at risk. The reason why is because we want to take on maybe 10, 12, 15 trades and hold those and continue to walk those through each day and allow for a portfolio of some of these stocks, because we're getting stocks that are entering trends at different times and exiting trends at different times. Just like that Disney was in an uptrend. Then it rolled over. Something else took its place in an uptrend. We want to try and rotate that. We call it the wheel methodology with utilizing TradersPro stocks. As you're adding into your portfolio, you're doing it systematically on these kinds of stocks as they're either entering new trends or continuing new trends. This is a continuation pattern where it's already in the new trend. It's retraced back a little bit, finding support, gives it that new springboard. And if I want to take a trade on that, I want to know what my risk is. I could also then secondarily say, okay, this is worst case scenario. Worst case scenario, this stock drops to zero and I lose $2,000, which is 2% of my capital. Ouch, that hurts. That's painful, but I'm not out of the game. That's not a catastrophic loss if I were to lose everything on this trade. But that's not going to happen. I mean, the probabilities of that happening on an individual stock are a lot lower because stocks just don't go to zero very fast. Okay, it happens a lot slower unless something crazy is happening, like the subprime mess and Lehman Brothers and Bear Stearns back in the day, where stocks were going bankrupt because of really crazy circumstances. That can happen. That's always a risk. But what isn't impossible is a 50% loss or a 30% loss or a massive gap down on bad earnings or something like that. So we control that risk by position size. Okay? There's no other way to do that. There are other ways, I shouldn't say that, but this is the easiest way to do it without having to hedge anything or add any kinds of protective put options or things like that that can additionally be added. If you had a lot larger account, if you were managing a massive amount of money, it's a lot harder to exit or take on these positions. So you may set up hedges and things along the way as well. But just for the vast majority of us, this works fantastic. We want to manage our risk with our position size. Now we can have a stop loss. The most natural stop loss place is going to be below this hold signal, from the hold back to the buy. So if I were to say I want to place a stop at 572, what does that look like now? 572, 5.72 puts me at 0.22 at risk, or $240. So if I bought right now and I have a stop loss right here and the stock were to trade all the way back down, then I get stopped out. I'm risking $200, 10% of my trade size, which was the 2000, and my portfolio at risk is now 0.22. That's an acceptable level. Typically we'll go up to 0.3, and in this case, continue to let the winners run, and then we just cut the losers. To cut those losers, when it starts to look like this, we get stopped out, we move on to the next one. And in this case, a lot of times we're 40, 45, 50% win rate, but our winners are usually a lot bigger than the losers because we're cutting those losers really quickly. And then once and that's sometimes a weeding out process. There's going to be some that it's like, I don't know if this is going to be the one that rockets higher. Okay. And if it's not, then I'm going to be out. But the next one I buy into tomorrow could be the one. The next one after that could be the one. And so we go through and rotate through stocks relatively quickly so that we can really find those that ultimately are going to continue this trend higher. And we hang on to those until we get some nice gains. And then we also, manage with trailing stop, sell some into some strength, so we're locking in some gains as well. That's again, I'm going to cover that a little bit more each week as we're going through this entry process. That seems to be the most interesting topic for most people right now, and I think it's the most valuable, honestly. The risk management part of it, finding a stock to trade is not that hard. You could pull up any chart and just buy it, right, for any reason at any time, but you want to know these other factors. What's my risk and why? Why am I taking this much risk? And should I be taking this risk? And do I realize how much risk I'm actually taking? And getting stopped out and having a loss is a part of doing business. Okay, trading and managing a portfolio is just like a business. You have costs, you have expenses, you have risk, and our cost of doing business is getting stopped out. Okay, in doing so, we're trying to find the diamond in the rough. We're trying to find those ones that really have strong momentum. We do the best we can by starting with high-ranked, strong stocks that have really high probabilities of moving higher. Okay, big volume, there's interest there, there's big institutional demand happening, and we want to participate in something like that as it's moving higher. But if I have a $10,000 account, do I buy $10,000 worth of the stock and then sell it and then buy the next one? Or there's a lot of risk in taking just one shot with a larger amount of capital at one trade, at one stock. Instead, manage, spread that out a little bit. And then also the market conditions. When we're at the top of a market trend, we don't want to play, tempt fate, play with fire. And that is, we know what happens. We know what markets do when they get to these levels. It doesn't matter what the new technology is. Okay, call it, the .com bubble, call it the subprime bubble, call it the industrial revolution, the automobile, the radio, the television, whatever technology is happening, the markets are going to overreact to the upside. And maybe it's not an overreaction if that technology is delivering. right? If the technology is actually doing amazing things and companies are wildly profitable, that can last a long time. But at some point, we will overshoot and we will retrace. So we want to manage that by managing position size as well. Okay, so right now, portfolio size, we're a little bit less than 25%. The rest is in cash. So we're managing a small group of trades and the rest is sitting in cash. That could be in terms of your individual risk profile. You could say, I'm not comfortable with any volatility at all, and I want to just sit it out. Or I'm going to be a little bit more aggressive than 25%, or I'm going to be a little bit less aggressive. I'm going to have maybe a 1% at risk, or whatever the situation is. Make sure it falls into that comfort zone as well, so that you're not feeling like you're out of control and saying, oh my gosh, why is this thing falling so much? In this case, you're going to know where your line in the sand is. If I were to say right here, my stop is at 105, and if I were to get stopped out, it's going to cost me $225, kind of based on that last example. I know what to expect. Now, what I can't expect is if something happens after hours and it gaps lower, like earnings. I don't think they have earnings coming up real soon, a few more months out. Those sometimes can do this. We can benefit from those, but we can also not benefit from those sometimes into those earnings reports. But knowing what the risk is such a critical point of managing a portfolio. I'm going to end on that note. I appreciate everyone's time and effort today. We'll see you on Thursday. Thanks a lot. Bye now.